Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking U.S. economic data, general pullback, maybe a rollover in the U.S. dollar, what it all means for a potential recession in the U.S., and what's going to happen with markets as we just saw the S&P and NASDAQ, again, push to all-time highs. Chatting with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market blog. Now, Marc, broadly, this week, we continue to see weaker economic data out of the U.S. Jobs data, at least backward revisions to recent numbers, show, again, kind of a slowing in the job market. Now, it's not a true contraction, but you take a look at what the monthly job creation was over the last couple of years, and it's clearly on a bit of a downward slope. This week, we also had softer than expected services numbers. Overall, we seem to be seeing the U.S. economy slowing. It's not in contraction, but it's definitely slowing. Take us through the numbers that stood out to you, please.
Yeah, sure. So I agree with you. I think that, ever since we got out of COVID, basically, people have been talking about another recession in the U.S. And they've been proving this wrong. The economy has been very resilient, helped by strength of the consumer, helped by fiscal spending. And now I think that there's beginning to be some more compelling signs that we're at that inflection point, that the U.S. economy is slowing, and it's likely to mean Federal Reserve cuts rates twice this year, once in September, once again in Q4. The data, and I'd say what's surprising is up until now in this cycle, we've been focusing pretty much on the jobs data, the CPI, and the Fed FOMC meeting every 6 weeks. But I think that what's happened in the last couple of months, the market's been putting more weight on the ISM services. This is the PMI from the Institute of Supply Management. So even though the S&P, the PMI, they have a service reading, the market's putting more weight onto the ISM like iteration of this. And we saw the services fall, the headline of activity 48.8. So that's below that 50 boom bust level. And you had a week that is below 48 new orders. And this then followed the weekly initial jobless claims in the U.S. The 4-week moving average we used to smooth out some of the volatility rose to its highest level since last August. And then we had the jobs data today, Friday, a few hours before we were speaking. And while the headline numbers seemed to come out all right, the details were a bit poor. And there, I think I take your point that the downward revision took off 111,000 jobs in the last 2 months. Private sector job growth, 136,000. And people like myself will use a moving average just to try to, again, smooth out some of the noise. 3-month moving average for the private sector job growth, lowest level since early 2021. And so the big takeaway, I think I should also quickly add, the unemployment rate went up a little bit, 0.1 point to 4.1%, even though the participation rate also went up. So bottom line here, fully concur that points to a slowing of the economy. The Atlanta Fed, they had that GDP tracker. You can find that through the search engine, and they're at 1.5%. A couple of weeks ago, they were above 3%. So we've seen a real downshifting in expectations, and with growth, what this has done is it's fueled this idea that maybe the Fed can cut rates sooner than many people had previously expected. Just this week, the U.S. 2-year yield fell 15 basis points. We're going to close the week at 460, which we haven't done that. We didn't do that at all in Q2. We didn't do that since the end of Q1. And you look at our 10-year yield, and we're at 427. We're down about 12 basis points this week. And that's also a relatively large move given the news stream itself. So I think that U.S. economy weakening, Fed more likely to cut rates twice. And I think that finally we're getting the dollar rolling over. A couple of currencies look like they're breaking out, like the Aussie. We were in a 66, 67 cent range for the Aussie. We broke out around the middle of the week and we haven't looked back. Sterling's finishing the week. They had the election. No big surprise there. But sterling's finishing the week near 128, which is the upper end of where it's been this year, really. A euro also firm. The currencies that haven't shown some strength, I'd say Japanese yen, the Chinese currency, and the Canadian dollar. Sorry, Corey, but Canada had some weak jobs data this week and generally just underperforming. And I think it's the only G10 currency down today.
Well, Mark, when you think about this backdrop of economic data you just laid out and the expectation that the Fed will probably be cutting twice this year, I mean, we should make the point that the market's been wrong about where these rate cuts would be since last year, all the way into this year and all the way through this year. So I don't know how much stock we can put in what the market expects versus what the Fed's actually signaling they're going to do. But there is a dichotomy between how the market has responded, because the markets are up at all-time highs, and what the historical precedence is for when rate cuts come. So could you maybe speak to that dichotomy? What the market thinks is, oh, good, more free money from the Fed, versus how markets usually behave when a rate cutting cycle starts.
Yeah, I think that, Chad, you raise a good point. Why does the Fed cut interest rates? Well, the Fed cuts interest rates because they're worried about the economy, not today's economy, because we know monetary policy takes place with a lag. And so what they got to do, they got to look at today's economic entrails, so to speak, and look at those and try to anticipate what does that mean about where we're going to be 3 or 6 months from now. So I think that more Fed officials seem more concerned about the economy, more willing to, think about a cut sooner rather than later. But of course, there's there's a cacophony of Fed voices, and they all say they need more economic data. Well, we're getting more economic data. Today's jobs data. Next week, we'll get the CPI. It should be another soft CPI. But the Fed cuts because of adverse economic conditions that they anticipate. And so to go out and buy stocks because the Fed is cutting interest rates, because they're less confident about the economic outlook, it seems to me to be where the disconnect is. Lower rates help, of course. And it's a question, too, of what you think is priced in the market as far as on corporate earnings. But in general, the stock market typically falls. I'm looking at the S&P 500. It typically falls in the 12 months after the first Fed rate cut, because the Fed, again, is anticipating weaker economic times. Weaker economic times mean weaker earnings, typically weaker consumption, weaker demand. So I think we need to be careful. But of course, to your point, Chad, I've been nervous about the stock market since the S&P took out that 5,000 level. We've had some pullbacks, but still, as Corey mentioned, we're at record highs, really.
So, Mark, what about the fact that if we get rate cuts, and just one rate cut is one thing, but a series of rate cuts, maybe bringing it down 100 basis points, do we get money coming in from off the sidelines, from money market funds, because they're not gaining, they're not earning as much?
That's what I'm looking at. So I think that's the way it plays out, that the Federal Reserve cuts interest rates. It makes the money market accounts less attractive. And at the same time, you'd think that it begins easing the financial conditions to lay the groundwork for the next business cycle. So yeah, we got record levels in U.S. money markets. People like myself say, okay, stock market scares us. We're putting money in through our 401ks. We're bleeding it in, dollar cost averaging every time we get our paychecks. But still putting money, my savings, into the money markets rather than putting that marginal new savings dollar into the stock market. I think there's a lot of people doing the same thing. We can see that from looking at the money market assets. So I do think money comes in from the sidelines. I still think this is a good time for U.S. dollar-based investors to look overseas to diversify. Again, if the dollar is going to turn, if you have a basket of international stocks, the currency component could be about a third of your overall return. So getting the currency exposure helps. It's like a nice tailwind doing the underlying homework with the overall portfolio. So I think there's a time for Americans to begin still looking at international investments. We've got any kind of the topics I think are in 30-year highs or so, more than compensating you for the currency weakness.
Well, Mark, if the markets do see any weakness when the Fed starts cutting rates and people are looking for a safe place to put the money, you outlined there, looking internationally as a way of diversifying. People that are in money markets, if they're going to rotate that money to something safer, traditionally it would have been bonds. So do you think bonds will get some of that safe haven bid, or is that a different market now? Or what will be the safe haven that people rotate into if there's a market correction and they're looking for a little bit more secure profits?
Yeah, that's a good point. I think the Treasury market, the problem with the Treasury market, as we've seen in the past 2 weeks, is that since that debate between Biden and Trump, the market has been on edge. We've seen about a 10 basis point less steepening of the U.S. yield curve as people try to anticipate. I think the chain of reasoning is something like this. Horrible debate by Biden. It boosts the chances of a Trump victory. You see this in some of the surveys, some of the polls, especially in the swing states. And if Trump wins, how should people construct their portfolio and people are looking at, I think, a steepening of the U.S. yield curve. But if I'm right about the direction of U.S. interest rates that's lower and the direction of the dollar lower, then gold looks kind of attractive too. We've been trading sideways in gold. We firmed up in the last couple of days, but I could see a new leg up in gold, say above 2,400 or so, just based on the weaker dollar, safe haven desire, and the political uncertainty still. It's just on the horizon of the U.S. We could find out something relatively quickly about if Biden were to step down. He still says he won't, but there's still a lot of, it almost seems to me like more miscues as he's trying to correct the old ones. It reminds me of my trading where I lost some money during the tech bubble pop. I lost even more money trying to make back the money I had previously lost. So I think that's in some ways what Biden's trying to do here. So we can have a big shift in U.S. political climate quickly with not much of a warning now.
What about the global picture then, Mark? You discussed what's happened in other countries, but quite frankly, it seems like overall the world is moving towards lower rates and continued generally weaker economic data. So isn't this more the global situation now than the U.S. is in a way almost just catching up to everyone else?
Yeah, no, I think that's right. So I think of it like this. I think of it the same way with like interest rates. If the low interest rate country cuts interest rates, big deal. Doesn't really change the calculus much. But when a high interest rate country cuts interest rates, that's a big deal. And I think that's what's happening. The U.S., I can show, in my own work, I show correlations, say dollar yen. We know that like in theory, it should be correlated to the interest rate differential, say 10-year differential between the U.S. and Japan. But instead, higher correlation with just the U.S. Treasury leg. And I think this is what we saw in Q4 last year, Q1 this year. Remember Q4 last year, economy slowing down, Fed's going to cut. Fed says they're going to cut 3 times. Market says 6 times, maybe a bit more. And the dollar sells off. Even though global interest rates fell, the key is the direction of U.S. interest rates. And this, I think, is not just looking at the data, trying to come up with a narrative with it, but I think there's a broader understanding of the role of the euro-dollar market. That is companies and countries outside the U.S. that borrow dollars. And this is just a huge market and has a role to play when we try to explain dollar movement. And so broadly speaking, then, I'm thinking about it is a global move. I think you're right, Corey. Globally, it's taking place, slow down, lower rates for the most part. And I say for the most part because it looks to me, besides Japan, who could hike rates later this month, Australia looks like they're edging towards a rate hike as well. Remember, they hiked rates late last year, throwing everybody off and being the sort of odd man out there. But broadly speaking, I think that the key to the dollar, key to the investment climate is not so much the interest rate differential, though I understand the economic theory. It's really what happens in the U.S. I think we're really the linchpin. And so lower U.S. rates, lower U.S. dollar. But part of that global, we're moving more in sync with the global, with more converging, maybe a reconvergence, U.S. with the global economy.
Well, Mark, if you anticipate rates to come down and the dollar come down, does that give a little bit of life to the small cap sector? Because it's underperformed the mega cap side of things. The Russell 2000 and a lot of the small caps are more sensitive to borrowing money. So in a lower interest rate environment and a lower dollar environment, do they get a boost in that environment?
Yeah, I would hope so. I put a little bit of my portfolio into small cap stocks and it's not performing very well. But I think that it's not clear to me. I really think that you see a lot of criticism these days in the media about the overcapacity in China. And I think the cost of minimizing that excess capacity, which of course the U.S. had suffered from as well, the price of that is oligopolies. And so I really think that we've got an economy that's really driven by these, even if the small companies hire a lot of workers and are really the backbone of our economy. It's the large corporates that really dominate. And so I don't know if just the turn of the business cycle, because remember with the turn of the business cycle, which allows for lower interest rates, if there's weaker demand, businesses don't borrow money just because of low interest rates, right? They borrow when there's an investment need. And what concerns me, given the political outlook, is maybe some businesses hold off on capital investment and other decisions pending what they hope to be is a more friendly administration after November.
Yeah, it's a good point, Mark. And one thing to consider, right? Lower rates, those are good for some of these companies that need to borrow money, but there needs to be that growth there too. So if the economy's slowing and if the economy broadly is in for some problems, then it can be tough for some of these small cap companies to grow in that environment as well. But hey, very interesting. Starting off Q3 kind of on the wrong foot for the economy and seeing some interesting moves in markets and also in the currencies. Thanks for breaking everything down for us, Mark. We'll chat with you again next week. I hope you have a great rest of your week.
Thanks. Good luck to everybody.